let's invite Abneesh, the Executive Vice President, Institutional Equities at Edelweiss Securities, and GV Giri, the Head of Research at IFL Institutional Equities, to weigh in on this conversation. Abneesh, let me start with you. And on that subject of valuations, it's seen better days, right? As Prashant pointed out, the peak valuation is close to 36 times. I was just seeing a report. You're factoring in an EPS of 19.2 rupees for next year, FY22, which means roughly the stock is trading at 10 to 11 times. But for you, despite a lot of the concerns being addressed by the company, you don't think it deserves a valuation higher than 12 times, which is what your target multiple is on Zee Entertainment? Take us through why you've put the target price, the target valuation only at 12 times.
Yeah, thank you. So we have a buy on Zee even before the results, and it has been our top pick. Clearly, the steps which have been taken by the board and by the management has further increased conviction of ours and Street. See, first part is the overall discretionary consumption, if you see, versus what I think Street was expecting 2 months back, and now there is a big positive surprise across the board. And this is important because Zee gets its advertising from FMCG, from the discretionary sector, and that's very important. So paint companies, if you see, July, August, they have seen a double-digit volume growth. Titan Jewelry, if you see, again, July, August, yes, they are seeing growth, maybe because of activation, maybe because of base, but no one expected this 2 months back, 1 month back. Similarly, FMCG companies are now talking about volume growth in Q2. And again, people are saying that the entire first half and maybe Q3 is a write-off. So one is demand for both FMCG and discretionary has been better than expectation. Second, of course, is on the company, if you see, there's a good turnaround both in terms of business fundamental, intrinsic, and at the board level. We are seeing the company see 6% subscription growth on a very high base of 40-45% last year. Company has launched FTA channels. Company's market share is now back to 19.5, which is one of the peak market share, versus hardly 15% in the full quarter last year. And on the board level, we know the key improvements, but it's very important to highlight 3-4 key things. One is Mr. Gopalan joined after most of the corporate governance issues, and Zee has already happened. So now he is the chairman, and Mr. Subhash Chandra moves out of the board. I think Street is getting a lot of conviction because of that. Now 3-4 more new board members will come from finance, law, and marketing, media, etc. Second, of course, is after many quarters, we are seeing free cash flow increase, cash and investment increase, and they are giving guidance that free cash flow will see further improvement. Peak capex is behind us. So coming to valuation, if you see, most of the consumption names are trading at 40, 50, 60 times. Zee in good times has been seen as a quasi-consumption name. Last 2.5 years, that was not there because of the board level, promoter level concerns. Lot of which is behind. I'll say 80% of that is behind, but clearly the new management team which is there, Puneet Goenka is still there, board is largely new. They have to ensure that they deliver on a lot of these guidances which have been given, for example, quarterly disclosure on balance sheet, definitely free cash flow improvement, Z5 for further scale up, for example, delivering on the related party transaction from Dish TV, City Cable. If those things happen, this stock can go back to that 20-25 PE multiple. As of now, we have given 12 times. My sense is definitely the way markets are, liquidity-driven market, overall consumption coming back, etc. I think it can definitely test even 15 times if they deliver some of the numbers which they have been talking about. But if further board level improvement happens, it can definitely trade even at 20-25 times. Key risk is IPL happening.
Abneesh, I'm going to come back to you. Yeah, that's absolutely a very well-rounded 360-degree perspective there on Zee. But let me get in GV Giri of IIFL as well, who's on the phone line with us. He's head of research at IIFL Institutional Equities. Giri, thanks very much. Good to have you here. I mean, you guys have also you're finding the stock attractive. You've upgraded the stock to a buy. You've got a price target at 258. I mean, what stood out to you the most in these numbers, and maybe the commentary later?
Well, firstly, also a question of what's priced in. And the Street had downgraded the earnings of the stock quite a bit, and we were significantly below consensus. And as an indication of how low we were, and we'll change our earnings as I've written in the note after the annual report comes out. Z5 is costing the company about 600 basis points or even more, given the revenue compression of EBITDA margin. And if that had not been the case, then the company's EBITDA margin in these times would have been about 24%. So 24% is where they used to be 3-4 years back. So from that level, they've pulled it up quite a bit. And the improvement that the company is talking about is likely to start emerging in the second quarter itself, or towards the end of the second quarter, most certainly by the third quarter. And the company seems to be very confident about showing ad revenue growth in the second half, which is a remarkable turnaround considering that the rest of the economy is still not turned around. And the clue to this is probably in the improved viewership share. Secondly, we also saw that including Z5's investment drag, the company's EBITDA margin projection of FY22 is 30%, and we are at 24%. So our earnings are significantly below the company's guidance also. And despite that, the company was only at 13 times our earnings. And so we took, in our judgment, most of the negatives were priced in. And the company does not really have any incentive to give a very upbeat guidance and try to mislead investors. I think we are past all those kinds of problems with this company. And at various levels, it's beginning to affect a turnaround. And when that happens, the re-rating quickly follows. And it might go back to the mid-20s before long, this is what I suspect. But this is, the initial reaction is just based on the announcement for the company. But if they manage to deliver a cash back to the shareholders, that's the last word. You know, the bottom line is that the company has to return cash to the shareholders. The investments and the treasury surplus funds and all is good to know, but it's not as strong as the action of returning cash to the shareholders. When that happens, the stock can re-rate.
Giri, would you, a lot of the commentary I've read in terms of sell-side notes is a little cautious still. I mean, they're kind of not obviously going all in because it's a complete 360-degree turn, right? And it's hard to do. You change your view completely. What can go wrong from here, according to you? I mean, is there, or you think, I mean, it's really, it's going to be hard to mess things up from here on? I mean, it's a clean run from here.
No, it's not a clean run. Some boxes which are not ticked, one big box which is not ticked is Sugar Box, the company that they invested in. And while they've not made big payouts yet, only about 35 crores has been paid out. The original project size was 1200 crores. And imagine a company like Z, which is a television program producer, trying to give Wi-Fi on trains and buses. So nothing could be more unrelated. And they've got to absolutely scrap the project, or they've got to withdraw from the agreements or do whatever, but cut down the size of that investment to something much more manageable. Secondly, they have a very clearly articulated policy on treasury investments, but that's about surplus funds. Now, what if the funds don't become surplus? What if the funds are invested before they become surplus? Which means that we are talking about the investment policy. Now, the investment policy is a much less clear policy than the treasury policy, because if the management thinks that a particular opportunity is a good investment, an acquisition is a good opportunity, then what's to prevent the board from approving it in good faith? Thirdly, the board constitution, and let's see how it plays out. We want the management to have a strong but also independent board with expertise but not a bias. So that's also something to be watched out for. And the last one is Z5. Z5 is not a success story as of now, and they ought to bring down the investments and the losses in Z5. It's running at about 500 or 600 crores per year. And if they bring it down within 2 years, then I would consider that to be a success story. But they've got to report more than just the EBITDA now. They've got to start reporting the ARPU, and they've got to start increasing the presence in the OTT space. The other platforms are ahead of them at this stage.
Abneesh, let me get you in this argument. You spoke about Z and you said that historically it was seen as a quasi-FMCG player, and therefore, generally media companies should see the benefit of an economic recovery, ad revenues, etc. should go up. Now, viewers have a choice between a Sun TV as well as Z Entertainment. Purely going by a stock performance, you can see Z has underperformed a Sun TV by nearly 30% since the start of the year. But if I look at the valuations, there's not much difference. So for instance, Z and Sun TV are trading at low teens kind of valuations. So, Sun TV may have outperformed, but it still has the valuation comfort. So if someone has to choose a media stock, which one would it be between the two? And what are the arguments?
Sure. So we have a clear preference for Z Entertainment. One is it is far more diversified. Sun is focused on South India. Recently they have gone into Bengal. I think it's a bit late. Z's, most of the investment in most markets are done. They have in fact exited loss-making business like sports, which they have sold off. So that's a clear positive. Second, of course, is in much larger markets, Z has a formidable market share presence. In Hindi, for example, Sun TV has got no presence. So that's again very important. Third is, of course, in terms of management, promoter, board, there is a delta which is positive in case of Z. In Sun, it is status quo. Fourth most important thing is a leap out of FMCG. So FMCG companies, if you see, will earmark a percentage of profits towards new products. In Z's case, Z5 is exactly same thing. So I don't think investors are unduly worried on the losses which are coming in Z5. If you remember, now Netflix is so successful globally. Many years they made a loss. So that's why it's important that currently Z5 doesn't go into profit focus. They have to go for market share and ARPU and content focus. I think investors will appreciate that. So I would say that clearly Z5 is a clear preference. I think there are some risks also. If Viacom and Sony, the consolidation, for example, happens, I think Z will also need to look at some bit of consolidation, some bit of a tie-up with some telecom player. I think overseas investment which they have done, a lot of write-off has happened, that has to come back. And Hotstar multiplex is becoming very aggressive. So Z5 should not cut down investment. I think that will be a bit risky at this juncture. So those would be the key things the management has to manage.
Gentlemen, thank you very much for joining in. So that's Z Entertainment, the comeback stock. It's up 22% so far this week. And as GV Giri's note says it's on the road, though by no means at the end of it. So they managed to address all the past concerns surrounding the stock. Let's see how the future plays out. With that, we'll slip into a very short break. On that note, we'll come back and talk